Strong operational results for integrated chemicals manufacturer Atul Industries in Q2 brings a case that it may not only recover faster but also gain market share in the process. In our Ideas for Profit today, I'll discuss what should be investors' strategy post the robust performance in Q2. Well, Atul's Q2 sales marginally slipped by 4% year-on-year, and that was chiefly on account of 8% decline in the sales of performance chemicals segment. Now, however, the performance chemicals top line was actually weighed by the product price realizations on account of the pass-through effect of the slump in the input cost of oil derivatives. Now, the life sciences chemical segment sales were actually stable with 5% year-on-year growth this time. Now, the highlight of the quarter was definitely the margin gain. The gross margins also improved by 276 basis points. This also helped the EBITDA margin expansion of 460 basis points, which was further helped by the lowering of the operating costs. Now, EBIT margin improvement for performance chemicals was noticeable at 410 basis points. On the other hand, its microcap subsidiary, Amal Limited's quarterly earnings reflected a decline in the oil derivative prices. Now, Amal's revenues declined 24% year-on-year, and that was due to the lower product price realizations as well. Further, EBITDA margin severely contracted due to both lower gross margins and the operating deleverage as well. Operationally speaking, Amal has been a turnaround story, benefiting from superior cash flows in the last fiscal year. It reduced the debt also by more than 50%, leading to a debt to equity ratio of 0.13. Encouraged by this, the company is evaluating a major capacity expansion. Now, interestingly, last week the company also incorporated a wholly owned subsidiary called Amal Specialty Chemicals as well. However, the recent results have demonstrated our caution that the strong margins witnessed in the earlier quarters may not really sustain for long due to the commodity nature of the products. Now, this has kept us on the sidelines along with the valuations on the subsidiary. Amal stock trades at a premium of 17.3 times FY22 expected earnings to the average multiple for basic chemical segment. Coming back to Atul Industries, the life science chemicals segment continues to witness steady performance due to the positive trends for agrochemicals and pharma end markets. Also, at the same time, sharp sequential improvement in performance chemicals also, when you see, however, is suggesting a pickup in the discretionary demand, though part of it is also due to the pent-up demand that was built up during the lockdown. Having said that, we are enthused about Atul due to its strong operational show. Apparently, this is the highest operational profit that the operating profit margin historically, and more so for the performance chemicals in Q2 that the company has reported. Working capital management is quite steady. Free cash flow of 248 crore rupees for H1 is better than the same period last year, even though Capex investment remains on track. Also, the company is investing 487 crore rupees in various Capex projects, and once these projects get commissioned, the aggregate sales potential of the entire thing would be about 5,400 crore rupees at 90% of utilization. We also believe the company's near zero debt balance sheet keeps it at a vantage position for near-term Capex as well. Now, for global MNCs, the current crisis adds to the growing theme of sourcing chemicals from India as an alternative. Atul Industries is in a better position to deal with the hurdles with respect to, say, operations, supply chain, working capital management, all of which can really help them gain market share in the domestic market per se. Though valuations are not inexpensive at the moment at 18.1 times FY22 enterprise value to EBITDA, the current consolidation phase and the strong operating results definitely make us constructive on the diversified chemicals play, also the company with a strong balance sheet. Diversified business model not only helps to navigate the business cycles and limit the volatility in earnings, but also are a prime reason why valuation premium should actually sustain going forward. So the current consolidation therefore provides an opportunity to accumulate, Atul.